kicks. Right. Good afternoon, everyone, and welcome to the webinar, first of the many webinars which are planned for the end of the year and continuing over the next year as well. Let me start by sharing the presentation and then we'll kickstart. This seems to be a challenge. I need to have the rights to share. Seem to have the right to share the screen. Yeah, now I can. Perfect. Let me share the screen. Share. Right. Can everybody see the screen? Awesome. So today's topic is about the cash flow management, the lifeblood of your business. And before we start the presentation, uh, the first question to think about as we look forward to 2024, how are you feeling about your cash, sales, and profits? The 5 options, have a read through it, see how you're feeling, and just message in the chat. And then what we'll do is over the course of the webinar, we'll sort of share how everybody's feeling, and we can have a discussion towards the end about what to do. And this presentation will give you a lot of tips in terms of wherever you are in the cash flow cycle, wherever you are in the sales cycle or the profit cycle, what to do with it. So the first thing, what is the difference between these two images? I've got two images of the same thing. What is the difference? Right. One is the image of the earth with oxygen, which is on your left-hand side. And on the right-hand side is the image of the earth when it's devoid of all oxygen. The earth dies. So just turn off my phone. It's making a lot of sound. Okay, perfect. So yeah, so that's what it is. That's what happens to Earth when it's devoid of oxygen. And the reason why I brought this up is the next slide will reveal that there are a lot of businesses which are set up every year, but there's a very high failure rate as well of the businesses. And if you look at the number one reason in this slide, it's basically the businesses run out of cash. And cash is really the oxygen of the business. And that's the reason why I brought that slide up in terms of if you devoid anything of oxygen, it is no longer alive. And that's what happens to businesses. If the cash is not there, the businesses fail. There's a lot of other reasons as well. So you've got the insufficient startup idea development, failure to comply with legal, poor or no financial management. There's many other reasons, but the number one reasons that businesses close down is because they run out of cash. But there's another important fact, which is even more interesting. It's to do with 82% of the businesses that fail due to cash flow. So you can see there's 7 reasons, but 82% fall because of the first. But the more interesting fact is that 69% of those businesses which fold due to cash flow problems were actually profitable. So these are profitable businesses that fail because they have not managed their cash flow very well. And today's webinar is all about how you manage the cash flow. What are the different factors that you need to take into account? What does a cash flow statement tell us? All of these things will be covered in today's webinar. So I believe I've answered that question. Have you ever wondered why cash flow is considered as the oxygen for your business? It is because you may be profitable, but if you don't manage your cash, the cash, the business dies. And that's the reason why it is considered as the oxygen of the business. Simple question: what happens when you don't get oxygen? What happens to your body? What happens to your lungs? What happens across? And that is what will happen to the business if there is no oxygen. Just as oxygen fuels life, cash flow fuels business growth and sustainability. And would like to know from the participants, raise your hands if you've ever faced these issues. Are your customers paying too slow to make payments? Are you constantly in that cycle whereby you're trying to make ends meet? You're trying to figure out at the end of the month how to pay the salaries because your supplier has not paid you, or sorry, your customer has not paid you. Are you thinking, okay, I've got a big payment coming up, my supplier payment, where will I find the money from? Because my customers are too slow in making payments. How will I keep up with my commitments, perhaps for the loan? Uh, are you thinking are your overheads too high for you to constantly manage the cash flow? Do you have any cash reserves? Typically, any business should have cash reserves. I think we've all sort of come out of the COVID situation. The whole world suddenly crashed for all of us, for a lot of the business owners. But a lot of the businesses that survived had some cash reserves. They were able to use those cash reserves to pivot, to be able to stabilize their business and then make the right decisions. And they prospered during those, in terms of adversity. They prospered in adversity because they had the right amount of cash reserves, which they were able to utilize to stabilize the business and take in opportunities and sort of grow with them. Do you have too much bad debt? Are you managing your cash flow? Are your customers great? These are some of the things. Are you facing these issues on a day-to-day basis? And are you thinking about it? Now is the time when you start, because it's coming to end of the year. You need to sort of perhaps start taking some action as well. How is your stock situation? Are you sitting on dead stock? Are you sitting on stock which, on the face of it, there's a lot of value which is sitting, but is it really worth that much? Are you holding too much stock? Can you optimize your stock? Are all of these issues on the top of your mind? Do you understand your financial statements? Is like when the accountant, someone presents you the financial statements, whether it's the monthly management reports, whether it's the audited financial statements, do you understand what is the implication of those financial statements? So if you faced any of these issues, you're not alone. A lot of entrepreneurs, we've been working with entrepreneurs for the last 30 plus years, and many entrepreneurs that we work with face these similar issues, perhaps differently worded, but on the crux of it, these are some of the issues which are very, very common. These are the common themes that we've noted across many years of working with entrepreneurs and helping them achieve their financial goals. So now let's go on to understanding the impact of the effective cash flow. So it is, we've already established that it is essential for maintaining the operations. It is essential for investing in growth and meeting financial obligations. There are so many businesses that we work with, and their whole objective is that they need cash for sustainability. So they need cash to survive, not even sustain. A lot of the businesses operate on the basis of I need cash to survive. But realistically, the real way of managing the cash flow, and that's why it's important, is that you manage the cash flow not just to survive. The survival is a given thing. You need cash flow to sustain your current business, plus, more importantly, have the cash flow to grow the business. So the cash flow is required not just for sustaining, but for growth as well. You need to be able to meet your financial obligations as and when they come true. But that is called sustaining or surviving. More important is your business generating enough cash for growth as well? If not, there are things that can be done. Businesses that are proactive with their cash flow management are most likely 50% more likely to weather the economic downturn successfully, and that we saw during pivot, the businesses that pivoted during COVID time. So just to give an example, how important the cash flow management is, if you look at it, this is the 2019 headline. One of the startups in UAE, in Dubai, had raised close to $15 million, which included a 8.5 million Series A funding in June of 2019. It made it the second best funded startup in that category. So amazing story, amazing growth story, amazing profitability. Everything was working right. 18 months later, before December 2020, just 18 months on, it basically went into liquidation after running out of cash. More than $15 million was spent with little to no cash flow management, resulting it into going into liquidation. Board resolution was passed, and so the liquidators were appointed. But you see, this is the story in terms of it's not about raising the funds, it's about raising and managing the funds as well. Once you are managing the funds, you need to have enough buffer and enough time frame for you, if you require further funding, to be able to manage and start the process of further funding well in time, so that you don't run out of cash and run out of steam, and then the inevitable happens when you run out of oxygen. One of the most well-respected entrepreneur, Sara Al-Madani from UAE, according to her, a large number of UAE startups, she works quite closely with a lot of startups. So a large number of UAE startups that don't succeed fail due to cash flow management problems and overly ambitious acceleration plans. We are in that domain in which there are many incubators, there are many startups, there are people who are looking to accelerate, but it's not that we should not be ambitious. Absolutely, we need to be ambitious, but we need to be cautious as well. So if you think about it, your entrepreneur, what does an entrepreneur do? Entrepreneur is there. The main role of entrepreneur is to manage the risks of the business. That is really the key. And managing the risk is not saying that don't be ambitious. It is being ambitious, but being cautious with that ambition plans. It is about managing the cash flow, because as you know, once the cash flow runs out, the business doesn't survive. So it is about managing the risks. And when you are taking on, what is the benefit of having a customer who doesn't pay? It shows good on your profit and loss that, yeah, I sold this much. But if the customer is unlikely to pay, then what is the point of doing business with that person? And that is one of the key things, which is, again, a role of the entrepreneur, is to see that they are able to manage the risk of the customer, so that to ensure that they get paid on time in order to meet their outgoing liabilities that they may have. So one of the most important things is cash flow management. And the example that I gave is not alone. There are many, many examples where businesses have raised funds and then they've gone sort of bankrupt, liquidated within 18 months. There's another company that we recently looked at that went from a valuation of over $175 million in 1 year to less than $1 million within 18 months. There were other issues, product and things like that. But again, cash was one of the key metrics. They had run out of cash. The sources of cash funding had dried out because of some other reasons. But again, if it was managed well, there could have been a pivot. They could have realized that, okay, things are not going the right way, let's pivot. But they left it till too late. And by that time, the writing was on the wall. So what are the benefits of cash flow management? First is the increased and improved financial stability. You need that stability to reduce the risk of financial distress and insolvency. That's the most important thing. That's why you start the business to grow, not for it to be liquidated at some stage. But as the statistics show, 82% of the businesses fold. And a lot of those are because of the cash flow reasons. Informed decision making. You can make better investment and growth plans. So if you've got the right cash flow, and if you're making, whenever you're making any cash flow decisions, you are, or any investment decisions, you are actually seeing, okay, what cash flow would be required to firstly to implement that investment. So how much money do I need to invest? Do I have that money? If I don't have that money, what are the sources of funds? Do I go for debt? Do I go for equity? Do I have the funds? Do I raise funds from external parties? Do I raise funds from friends and family? What is it that, how will that investment, how much fund is required? How will I raise that funds? That is the first step. That will fuel the growth. Now you need to be ambitious about the growth, but not overtly ambitious. So then you start to look at, okay, whoever has funded would be looking at some sort of return. So if it is a debt funding, then there has to be monthly repayments or a quarterly repayments or whatever has been agreed for the debt plan. So you need to see that your investment is going to generate enough cash to repay the debt as and when it falls through. If there's an equity, then you need to think that, okay, as an equity shareholder, somebody who's brought in the funds as equity is taking on the risk on the business. So then the question is, okay, how much return on investment would they get? That return on investment would be in the form of dividends to pay cash, or would that be in the form of valuation, increase in valuation of the business, whereby you don't take the funds out of as dividends, but you reinvest those funds, and then when you go for the next round of funding, the business value has increased. What is that informed? So everything is basically based on informed decision making. The third thing, I had mentioned at the start that there are many profitable businesses who go bankrupt because they don't manage their cash. But one of the key things is to generate long-term sustainable cash, you need to be profitable. In the short term, you can generate cash from a loss-making business. It is possible to be cash positive, but loss-making. It is feasible. And I'll give an example of that. But that cannot be sustained over a long period of time, because sooner or later something will catch up and you will end up having closed down the business because some things will catch up. The example that I can give is, for if you've got suppliers who are happy to give you a credit, very simple things. You can buy stuff and you can negotiate with your suppliers that you will pay them after 90 days. But your customers, you negotiate with your customers and you get cash for it day one. So what has happened is you receive some goods. You didn't have to pay out for the 90 days. For the next 90 days, you can keep buying and keep receiving cash against those goods. So what does that mean? That means you are generating cash. But what if you purchase the goods for 100, but you're selling it for, say, 75 or 80? That may be a reason that your customers are flocking to buy and giving you cash because they can't find that price in the market. So what you've done is you've created a positive cash flow for your business for the 90 days. So you're cash flow positive, but you are loss making because you're buying and your costs are much higher than the sales price. And it happens because I'm using a very simple example of buying a product and selling it, but sometimes there is manufacturing involved. Sometimes there is a value add changes required on the product. And if you've not costed them properly, then you could be in a situation in which your selling price is lower than your cost. And it happens. And that is when, and if you are getting money for your selling price immediately and you can delay the supplier payments, that can cause a positive cash flow, but a negative loss. As I said, can be done for a short period of time, but not over a long period of time. So when you start to manage your cash very well, you look at all of these different elements. And gradually what happens is you start to improve your profitability because you're now looking at how do you maximize the cash generation, minimize the unnecessary expense. You start looking at the expense. You will, if you're managing your cash flow very well, you will suddenly realize, okay, there seems to be a mismatch in terms of my cost and expenses and the revenue coming in. So you will start to take the right action so that it improves profitability for the business by cash flow management. And then the last one is enhanced supplier relationship. So how many of you love to get delayed payments from your customers? That's a rhetorical question. You don't have to answer. Nobody loves to get paid late. Everybody likes to get paid on time. That is from your customer. I asked this question about your customer. Think about it from your supplier's perspective. If you are one of those companies which is able to pay the suppliers as and when the liabilities fall due, how would your suppliers love you? Do you think they will go out of their way to support you in case at some stage your business suffers some sort of issues in terms of payment, in some terms of, suppose your customer stops, one of your customer goes bankrupt and you still have to pay the supplier? Do you think they will support you because you've always been an honorable business, you've always paid them on time, you discuss with them openly? They will support you. It is not just important to collect money, it is also very, very important in the cash flow management cycle to have a good supplier relationship, because suppliers help you execute, help you with your operations, which gets your customer satisfaction, and then the customer pays you. So having the right supplier relationships is extremely critical. And benefits of the cash flow management is, you know, when the supplier is due, they will get paid. Supplier is happy, they will prefer to work with you. Think of another situation. I used to work a lot with the events industry. And typically, if you have good supplier relationships, what happens is it's a very cyclical business. So when there is no business, supplier will support, will provide the information, provide you whatever goods you require at last minute notice, anytime, if there is a low season. Think about it, high season, supplier is extremely busy. That supplier gets two contracts from different companies. One of those companies is your company, and you've always sort of paid them on time, and so you've got a great relationship with the supplier. The other company always delays payments, things like that, perhaps maybe a bit more lucrative offer than yourself. Now, supplier has got a capacity issue. Either he can service you or this other company. Who do you think the supplier will service? Absolutely, it would be yourself, because the supplier is happy. He knows when he provides the service to you, he or she knows they will get paid on time, whereas they've got no guarantee of any payment from this other person. There would be delays, things like that. So effective cash flow management definitely enhances your supplier relationship, which enhances your quality of service that you provide to the customer, which enhances the customer satisfaction, which enhances the receivable from the customer. So it's all joined together. That is what a cash flow management is. Now we'll go through some of the things of how to effectively manage your cash flows. First and foremost is tracking your cash flows. Very simple saying in life, you never get what you expect. You only get what you inspect. Inspecting and tracking your cash flow is the number one step for your success in cash flow management. Forecast your cash flow. Always. So there are different. So we work with many businesses. Some have a cycle or life cycle of 3 months. So their whole working capital cycle of 3 months. Some have got a very shorter life cycle. At any point of time, it is absolutely important to have visibility of your near future, which in our terms is 3 months. Need to do a rolling cash flow forecast for the 3 months. Consistently, every month you do the forecast for the next 3 months. It's not just important to just do the forecast. So if you look at the forecast, there's no point creating a plan if you're not going to track against your progress against your plan. So first one, which I mentioned about tracking your cash flow, it ties in very nicely into your forecast, your cash flow. So you forecast. Once you forecast, at that stage, you then create a mechanism to track and take corrective action. You are constantly and constantly evolving. That's the key to the success. Manage your debt, minimize your debt, and prioritize repayment. So as soon as funds come in, if you have got debt, then prioritize the repayment of the debt. You should set the money aside for those debts because you have to pay them on time. Your credit worthiness is your credibility, which will allow you to raise funds if it is required to be raised in future. If you can't manage your debt, a lot of the institutions will no longer be willing to lend you the money in your time of need. Negotiate payment terms with suppliers and customers. So one of the key things is whenever we have this discussion, it says when I say negotiate payment terms, it's construed. Okay, when I say negotiate payment terms, what I'm looking for, ideal scenario for me is extend supplier payment terms as much as possible. If you can extend, if you're on 30 days, extend to 45, 60, 90 days. Negotiate with customers early repayment. So if you're on say 30 or 60 or 90 days, if you're on 30 days, get them on payment on 15 days. If it's 60, try and negotiate it down to 45. And so what the aim is, get the money from the customers quicker and delay the payment to the supplier after negotiating. Once you've negotiated, manage your cash flow very well so that you can pay them on the negotiated terms. Because when you pay them on negotiated terms, your credibility is established significantly. And that is what is required for effective cash flow management. Control your inventory. So if you're in service business, then it's something which you don't need to worry about. Sorry, but if you are having a business which requires inventory, control your inventory. Effective inventory management is absolutely critical because that's where a lot of the funds can be tied up and you may not realize how they are affecting your cash flows. And one of the best ways to do is offer early payment discounts, encourage customers to pay early, collect receivables promptly, implement a collection strategy, agree with the customers when they're going to pay, send follow-up emails prior to the due date, and just say that I'm expecting this. Thank you very much. Establish the right relationships with your customers. And use technology. There's a lot of accounting functions nowadays, accounting softwares, which come built in with financial tools, whereby you can make notes of customers, the comments, you can give them access direct to the portal. The payments can be made through a lot of payment gateways nowadays, so customer doesn't have to sort of go through the process of putting your details into your bank account, opening up a bank account, then paying yourself. You could send them payment gateway links, they just need to type in, pay through the credit card. So make use of technology to ease the payment so the customer doesn't have to think twice or think of a reason not to pay or think of a reason, okay, when I get to office, I'll do it. Things can be done online, on the mobile. You're making it life easy for the customer to make the payment to you. The next, which I want to sort of touch upon a little bit, is the working capital. This is one of the most forgotten funding requirement. Now, what is working capital? Working capital is very simply the funds required to run your business effectively. The way it works is it's effectively when you purchase the goods, bringing the goods, paying off the suppliers, managing the inventory. So first you buy goods, Second is you hold the goods for a period of time before it is sold off to the customer. So that's the inventory: purchase, stock, sale. How that impacts is the purchase impacts the supplier payments. How many days the goods you're holding in stock, that determines the amount of gap between you receiving money from the customer and paying the supplier. So that extends that gap. And then you've got the money receiving from customer. Absolutely important. These are the three key elements of working capital. And that is one of the reasons, one of why profitable businesses go out of business, they go into liquidation, because they are not able to manage their working capital very well. They buy stock, the suppliers want the money now, so they need to find cash, which they don't have to pay the supplier. Then they hold the stock for a period of time. They hope that stock will be sold off pretty much immediately, but typically it may take 30, 60, 90 days. So think about it. The supplier wants the money now, so you need to find cash for that. Now you're holding the stock. It's not selling. At the end of 30 days, you perhaps have sold some of the stock. You sell it to the customer. Customer says, oh, I need 60 days or 90 days to pay you. So you accept that. So now think about it. For the next 90 days, you're not going to receive any money, but you need to keep stocking up because there's more and more sales going to happen. So you're constantly finding money to pay the suppliers who don't want to give you credit terms. And on the other side, the customers don't want to buy until you give them credit terms. So on paper, you may have bought it for 100 and sold it for 200, showing a profit per product. But if you run out of the cash to manage your working capital, you have problem. And this is one of the key things which a lot of the entrepreneurs do not manage very well. And that's why whenever you're looking at investors, one of the things that they look at is, what is your working capital requirement? You may need $1 million, I'm just using a random example, $1 million for investment, because you're looking at capital expenditure, you're looking at new offices, you're looking at new machinery, whatever the case might be. But if you've not built in the working capital in terms of buying the stock, raw material, conversion, stocking, selling, if you've not taken that into account, investor is going to lose faith with you very quickly, because if you have not taken into account your working capital, it is a serious issue. Third one, experience tells whatever you plan, it's twice as long and twice as much and half the returns. So this is one of the things you have to be realistic when you're putting together your financial forecast and you're putting together your working capital requirements. Invariably, especially if you are in the initial stages of your businesses, suppliers are unlikely to give you credit. You may put 30 days, you may not get 30 days. It may be advance payment. And also, you may think that, okay, your customers will pay you in 30 days. Chances are, if you are in the initial phases, they may try and delay 60, 90, 120 days. There are many cases like that. So this is where you have to build in some experience into your financial management. And the last one is crossing the break-even valley. And just before we go on to the next slide, it's basically break-even. Everybody understands is break-even is a point in which your total cost equals your total revenue. At that point, you're making neither a profit nor a loss. That's basically the break-even. But today I'll introduce a concept, which is the break-even valley, which has three different levels of break-even. The first break-even is your financial break-even. So financial break-even is effectively that you're able to meet all of your external demands. So you're generating enough revenue to meet all your external demands. That's your financial break-even. Sadly, in my experience, a lot of the businesses hover around the financial break-even. They start the business and then they say, okay, they feel, okay, I'm generating enough revenue to pay all my expenses. I don't have to perhaps worry. Sometimes I have to worry, but most of the time I'm not worrying. That's the financial break-even. That's the lowest break-even that businesses should aim to achieve very quickly after starting the business. The next one is the sustainable break even. This is the sustainable break even is when the owner or the founder of the business is able to take a market wage, because that is when it's sustainable. When you start the business, you can sustain it by not taking any monies or not taking any salary for a period of time, but you will not be able to do that for unspecified number of years or months even. You would expect to take some return. And when is the business able to give you that sustainable return is the important part. So that is called the sustainable break even. If the business have reached that, great. Congratulations. You've gone from financial break even to sustainable break even. The next one is the other important one, the equity break even. The equity break even is when you started the business, you would have put in some investments into the business. So when you are able to get the whole equity back from the business, that's the equity break even. Very important to think of all of these. At that stage, you are constantly thinking, okay, now whatever I've invested, I've got back, I've got a sustainable business. That's when the growth and everything else happens. And to do all of this, you need to manage your cash flows. So now let's just go into the final part of the webinar, which is more about the cash flow overview. Cash flow is effectively your ability to pay your bills as they become due. It is equals to solvency. And one of the most important things to note, there is a lot of law which has been written for directors, their responsibilities for a business, the founder's responsibility for a business. The founder's responsibility, according to the law, is not to make profit. There's nothing about the profit. You can make profit, you can make loss. The law doesn't say anything about it. What the law says is you need to be solvent. If you are not solvent, you can be charged for not performing your director's duties. Very important to know. As a director, the law in most of the states and coming here as well is that you can be charged for running a business insolvently, but you cannot be charged for running a business on losses. Losses may result in insolvency, but the law is very clear. It's the cash. Law also recognizes the importance of the cash in the business. And that's why we say cash is king for startups, not just for startups, for everyone. The other key thing is that there is a sometimes confusion or misunderstanding between profits and cash flows. So the pursuit of profit can send you broke. Absolutely. You can try and sell at a high price, but if you're not collecting, it can send you broke. Because you can end up doing deals which don't result in you receiving the money. You can make a profit, still not be able to pay your bills. We've already discussed some examples of that. So some of the next few points are basically things which you have to think about. Prepayment. I've written insurance. Rent is a big part of it. In many countries, rent is generally paid monthly, whereas here in UAE, we tend to pay quarterly, maybe annually rent. If we are doing that, we need to find the money. If your rent is from 1st of January to 31st December, well, you better have the rent money ready on 1st of January. If you don't, then you have an issue. So that's where the prepayments that we need to make, medical insurance, we need to make prepayment. Again, all of those require cash. The cost is spread over 12 months, but the cash is required at the start. Very important to note. Debtors, we've discussed about the payment terms. Stock, we of bulk discounts, they can help. So if you get discounts, you can, or if you give discounts, you can liquidate your stock very quickly and turn that stock into cash. Tax, VAT. VAT is started, it's now covering it up to 5-6 years nearly since VAT started in UAE. I work with many businesses when they become our clients. One of the things which they struggle is like, okay, every 3 months we have to find money for VAT. And for us, it's like, no, all you do is every month start setting aside a pot. So when the VAT payment is due, You just go into that pot and make the payment. No stress. That's the important thing. It's all about cash flow management. Capital expenditure. Obviously, if something has happened which you had not planned for, it's a different matter. You need to find cash for it if it is something critical for the business. But at the start of the year, always have your CapEx plan. What are you going to invest in? It's important. You need to know what you're going to invest in, and don't and make it a planned expenditure as opposed to unplanned expenditure. And the next one is about the cash to cash cycle. So cash to cash cycle is effectively from your purchase, effectively you cash has gone out for purchases to receiving the cash. So what are the delays? How can you improve that? The statement of cash flow. So when you're reading, so we talked about a little bit about reading and understanding your financial statement. So when we talk about the statement of cash flows, the statement of cash flows translates earnings in the income statement to cash inflows. So how does the profit, the statement of cash flows tells you how the income or the profit and loss is translating into cash. That is one of the key things which your cash flow statement tells you, or any person who's reading the cash flow tells it. It shows how good the firm is in realizing adequate cash from its operating business, because there's a line called cash flow from operating activities. So then it sort of gives the person, an outsider, but just by looking at the financial statements, how good you are or your business is in realizing the adequate cash from its operating business. It reveals if firm needs to look outside for other sources of finance. So if again, this is feasible because they suddenly realize, okay, you may be profitable, but your working capital requires more funds, and your cash balance doesn't have those funds, then it basically shows that, okay, there are some other sources of funding required. And when we look at the cash, when we're looking at the statement of cash flows in any financial statements, it includes cash and cash equivalents. So what does cash equivalents means? Cash, we all know what it means, cash in physical cash in hand or your money in the bank, but it also includes your short-term liquidity instruments, treasury bills if you're holding them, certificates, short-term certificate of deposits, commercial papers, things like that are all included in your cash and cash flow equivalents. I've given some of the tips as we were going along the presentation, but specifically, if you can automate payments, so that's where I said about supplier, maintaining good relations with suppliers. If you've got the right cash flow management tool, you will be able to automate payments, reduce the manual task, improve efficiency, reduce cost. You set payment reminders, so avoid late payments and penalties. Penalties are severe. Why go into that? You work hard to make money. And one of the simple examples which I give is, suppose for whatever reason, a penalty of 10,000 is incurred for whatever reason. To recover the 10,000 penalty, it doesn't equate to 10,000 dirham of sale. It equates to a lot more sale. So for example, you're making, say, 25% margin on your products when you're selling. Say you're making 25% margin. To recover that 10,000 penalty, you need to sell 40,000 dirhams worth of goods just to make enough money to pay the penalty. Because 40,000 times 25% is 10,000. So think of all effort that is required to cover the penalties if they are to be made, if you end up incurring any penalties. So try to put payment reminders so that there is no late payments and late penalties. Offer multiple payment options, cater to different customer preferences. Some may be happy to pay you cash. If they are managing their cash flow well and they can get a discount, then you are able to get cash earlier. Cash in hand is far worth more than a customer which has not paid. Customer list. Track your expenses regularly. Identify areas of cost reduction. This is a quarterly exercise which you can build into your processes, that every quarter you sit down as a business owner, founder, and you go through that cost reduction process. And reinvest the profits. So if you're making profits, find out ways how you can generate more and more cash flow. So we are coming towards the end of the presentation now. So your questions would fuel the discussion. Happy to have hear from you. Uh, let's make it very interactive. Any questions that you may have, let's go through those. But first, just would like to share something exciting. Uh, we have got an upcoming webinar on and 2024 budget masterclass. So on 17th and 18th of January, 2 days, we are not just going to go through and create a spreadsheet of budget for you. What we are looking to do is create a very compelling personal reason why you are in business, link that to the business model that you have, the value proposition that you're providing to your customers. We'll unlock the power of your personal why. We'll have a clear definition of your personal goals and your business goals and how we can mix the two, merge the two so that you are living the life of a successful entrepreneur. You will gain financial stability and independence. So it's not just a spreadsheet exercise. We'll go through a lot of other things, other aspects of the business, which will all come together for you to create the best ever year for yourself, the 2024. We've currently got an offer running in terms of by if you sign up prior to the new year, there's a 3,000 dirham discount. Uh, choice is yours. We'll create the full financial fitness service, which will help you to be a very successful entrepreneur in 2024. Some of the tools that we will be looking at is the business model canvas, value proposition. We'll create a one-page business plan. Some of the topics that I spoke about today, the working capital, we'll create that cash conversion cycle and we'll see how we can optimize that. We look at the power of one, how if we small changes in your business, we'll identify, we'll co-create those changes that need to be made, very small changes which have maximum impact to your business. All of these things and a lot more is going to be covered in those 2 days. It's a jam-packed day, 2 days of really gaining clarity and moving forward for 2024. To summarize, to master the cash flows, always compare the inflow and outflow. Your outflow cannot be more than your inflow. If that's the case, you're digging a hole for yourself. You manage your working capital extremely well, understand your working capital and manage it well. Maintain reserve funds, start building in the reserve funds, not just for some pain points, some emergencies, but also the reserve fund for growth. Have separate pots available for your liabilities that you are aware of. For example, your VAT, your salary. Start having those separate pots for those. And seek professional advice. If you require any further advice, you know how you feel you would like to help with implementing it, seek professional advice. To conclude, revenue is vanity, profit is sanity, but cash is reality. And if you don't live in reality, it can have severe consequences for your business. Thank you and stay connected. If there's any questions, happy to take them on. Type it on the chat and we'll take it on.